G'day everyone, welcome back to Pete's Investing. Today is May 25th, 2023. This is the US dollar chart analysis, technical analysis. You can see here on the weekly, we're broken up into a neutral positioning, but on the daily, it's showing a bullish signal. So very cautiously trading on the hourly or lower time frames based on a daily, but again, I prefer to trade when the weekly and the daily are aligned. Let's drill down on each of these. First off, on the weekly, this indicator down here is made up of the triple moving average of the price chart, which is moving average 3, 5 and 60, combined with the moving average 5 and 50 of the CCI 150. When they're aligned, it shows if they're aligned long, it shows a bullish signal. When they're aligned short, it shows a bearish signal. And when they differ or not aligned, it shows a neutral signal. And that's where we are today in the last couple of weeks. So neutral after breaking up from a bearish signal a couple of weeks ago. Looking on the daily, again, we've got this support down here at 10.050, and it bounced off that a couple of times, and it's actually broken up through this diagonal descending trend line, as I said a couple of weeks ago, and it's been showing this bullish signal for some time now. One thing you'll notice is we drew a Fibonacci retracement, and it's actually broken up just through the 61% level. And that's a positive. The 61% level is generally a key area to look out for. And when it breaks through that, it generally means that the trend is reversed for good, and it may continue to the upside. I say may, so just be careful. It could always bounce down. Nothing is guaranteed in charting. But generally, that's a trend reversal from the downtrend as it was in the last few months. So that's something to be mindful of as it moves up. So again, we're in a bullish movement on the daily. Now, I prefer to trade the weekly and the daily when they're aligned on the lower time frames. In this case, we're looking at the hourly. So just be mindful of that. At the moment, it just broke up from a bearish signal on the weekly, and it's currently bullish on the daily. So predominantly, if you want to trade based on the daily, trading long positions primarily. And we use the same logic or same methodology as the moving averages on the hourly chart to trade. Now, what I've got here, if I zoom out on the hourly chart, I've got here a divergence, and I'm showing this deliberately because this divergence seems to have failed, because what we did, we drew a bearish divergence here on the CCI versus a bullish divergence on the price chart. And if you follow my videos, I do say most of these divergences generally work out, but in some cases they fail. So if I'd have drawn that continuation, that's broken up through that divergence on the CCI, which means the bearish divergence has failed so far, at least, unless this rebounds back to the downside in the coming hours or days. But at the moment, it's failing, I would say. So we'll keep an eye on that. But zooming out as well, I've also got on the hourly chart, I've got this back test, and this runs throughout the whole period. There's no discrimination between weekly and daily trends. So it runs throughout the whole period, and it's going a long run. It's long program only taking long positions. So you can see there, while the price is going up, it was taking individual contract trades, and while the price was declining, it started to average down, and that took a hit on your profitability. And as I always say, to avoid that drawdown, you want to make sure you're always trading in the direction of the weekly and daily. So, for example, back there when that started declining, you'll notice there was predominantly short trades only, and during that period there, only short trades only, so you would not have taken those long trades had you were trading this strategy. Also on the daily, just want to go back a minute just to show you this here. In terms of divergence, just want to give you another example of how to read divergence and be careful of what you're doing with divergence. You'll notice here, for example, that on the price chart was a bullish divergence versus a bearish divergence on the CCI. Now, that failed because if we continue that down to the downside, that broke up through that CCI, which means this divergence during that period failed. But if you'll notice also, if I remove that divergence and I redraw it, if you continue it on, so that would have failed had you placed a trade on that. But if you moved it up to this one, you'll notice that's a bearish divergence versus if you extend that one to that high, right? They must be aligned on the same timeline. You can see there that's a bearish divergence and that's a bullish divergence. So that would have played out. Now, Let's go back to this one for a minute. If I drew a channel, let's go back to this original divergence. If I drew a channel between that low and that high there, to that lowest point there, you would have just made, you would have entered short there possibly had you traded that divergence initially. But again, you want to make sure that works out. So in this case, that would have failed. So what you need to do, again, using that same approach, and the channel is roughly drawn the same, so that would have been a false break, but you would have gone short there on that longer time frame. You would have gone short there, and that's where the CCI started breaking to the downside. And the way you trade that, again, if you're not familiar with my channel, you would have taken the previous low, which would have been probably that spot there, to the high. And again, this is a daily time frame, and the initial target would have been somewhere in the closest Fibonacci level. So you would have been probably at that level there between the 50% to the 38%, and that would have been your initial target. In this case, it dropped down as far as close to the 78% level. Actually, on the 78% level, it's hidden by that blue line. So that would have been a nice little trade to take had you targeted that area. But again, just be careful, because sometimes, depending on how you draw these, they have false breaks, but most of the time when you draw these properly, they work quite nicely. So to understand how to trade this and other trading strategies, I prefer to trade using the weekly and daily timeline, using the smaller time frames to trade, as opposed to, and I use divergence primarily as an outlook in terms of potential trend reversal or retraces. But to understand how to trade using this and other trading strategies, reference the links in the description below. Subscribe to my Patreon page, where we also scan for stocks, currencies and commodities. We also answer any Patreon member requests for analysis of stocks or currencies or commodities, but we don't make recommendations to buy. We just simply show you from an educational perspective how to trade. Again, thanks for watching. Subscribe, like and share the channel, and I'll see you in the next video.